Revenue and expense recognition. The revenue principle, which used to just be called revenue recognition, helps us to know when to recognize revenue, and how much to record. Revenue is recorded when the company completes some work. It has nothing to do with getting paid. It reflects the value of the work that was completed. If you get paid in advance for something, it's not revenue. The work was not completed. Expenses are the cost of doing business. In order to correctly record the amount of income, we need to match expenses to the revenue they help create. We will subtract expenses from revenues to get to net income or net loss. If revenues are greater than expenses, we have net income. If expenses are greater than revenues, there is a net loss. Adjusting the accounts. Seems like it should be illegal, but it's necessary. This slide shows the unadjusted trial balance for Aladdin. Note that many accounts have a balance that is most likely not correct. Supplies, for example, shows $700. Supplies get used up, so this balance is probably incorrect. There are two categories of adjustments, and then depreciation, which is a category all its own. Deferrals are adjustments for things we kind of put off calling what they are. Supplies, as an example again, are an asset till we use them. Then they're an expense. Accruals are the opposite. These are things that build up over time, like interest on a bank account. Depreciation allocates the cost to plant assets over the life of the asset. It has nothing to do with paying for the asset. So how do we adjust the accounts? The first example is prepaid expenses. These are things that we pay for in advance. It can be rent, insurance, anything you pay in advance. It can even be a gift card that you buy for someone. Aladdin pays rent in advance, 3 months worth. It figures out to $1,000 per month. Anything prepaid is an asset, so we would have recorded a debit to prepaid rent and a credit to cash on June 1st. All during June, that account shows $3,000 as the balance. At the end of the month, we want to show that $1,000 has been used up. We want to transfer that $1,000 from one account, prepaid rent, to an account that accurately reflects what it really is, an expense. So credit the asset and debit the expense. Supplies are also considered a prepaid expense. You buy stuff and use it up. Think of things like groceries. You buy them every week and then you have nothing to eat in the fridge. Seriously, you buy groceries and you use them up. If you recorded how much you spent, you would debit groceries and credit cash. If you didn't do the adjusting entry, you would think you had a lot of food, when in reality, someone, probably Maverick, ate it all. This slide shows that the company bought $7,000 worth of cleaning supplies on June 2nd. However, when they take inventory, they find they only have $400 left. That means they used up $300 worth of supplies. You want to record that expense for a couple of reasons, so the expenses are matched to the period in which they were used, and so the balance in the supplies account shows what's really there. Well, at least it was a short